Welcome to Risk Management for Beginners. Risk management is one of the most critical aspects of trading. While profits are the goal, protecting your capital ensures long-term success. In this session, we'll define risk management, explore why it's essential, and cover practical techniques to manage risk effectively. By the end, you'll understand how to safeguard your trades and minimize losses, which is key to becoming a consistent trader. Section 1. Why risk management matters. The reality of trading. Trading involves uncertainty. No strategy guarantees profits. Even experienced traders face losing trades. Risk management limits the impact of those losses. Emotional trading. Without a plan, emotions like fear and greed can drive poor decisions. Risk management provides structure, preventing impulsive trades. Survival and longevity. Traders who protect their capital survive market downturns. Preserving funds allows you to trade another day, even after losses. Example, imagine risking 50% of your account on one trade. A loss leaves you needing to double your money just to break even. With proper risk management, you avoid such drastic setbacks. Section 2. Key risk management concepts. Position sizing. Never risk more than 1 to 2% of your trading account on a single trade. Adjust the trade size based on account balance and stop-loss distance. Stop-loss orders. A stop-loss automatically closes a trade at a predetermined price, limiting losses. This protects your capital if the market moves against you. Example, buying EURUSD with a stop-loss 30 pips below entry. Risk-reward ratio. Aim for trades with a risk-reward ratio of at least 1:2. If you risk $100, your target profit should be $200 or more. This ensures profitable trades outweigh losses over time. Section 3. Practical risk management techniques. Diversification. Avoid putting all your capital into one trade or asset. Spread risk across different markets, stocks, Forex, crypto. Trailing stop loss. A trailing stop adjusts with price movement, locking in profits as the market moves in your favor. Example, if Bitcoin rises by $500, the stop loss trails by $300 to secure partial profits. Avoid over-leveraging. Leverage amplifies both profits and losses. Use leverage cautiously, ensuring you can manage potential losses without wiping out your account. Section 4. Monitoring and learning from losses. Review trades. After each trade, assess if the stop loss was too tight or if the position size was too large. Adjust your strategy based on lessons learned. Keeping a trading journal. Track entry and exit points, trade size, stop loss levels, and outcomes. Over time, this highlights patterns and helps refine risk management strategies. Conclusion. Risk management is the backbone of successful trading. By limiting losses, preserving capital, and maintaining discipline, you give yourself the best chance to grow as a trader. Next step. Place a demo trade with a stop loss and calculate the risk-reward ratio before entering. Track your results in a trading journal and refine your strategy. Mastering risk management isn't glamorous, but it's the foundation of sustainable trading success. Happy trading!